Thank you so much for allowing Manulife Bank to be a part of this great event. I'm just going to bring up our presentation. Michael, can you see that presentation okay?
Yep, you bet.
Fantastic. So a little bit about me. My name is Beau Banerjee. I am the business development manager, one of them for Manulife Bank. We've got business development managers across the country to support you. And today we really want to talk about retirement income and the sequence of returns and where does that play in when we chat about home equity as part of the overall retirement conversation. Now, I will say I do have my children at home right now in Ontario here. We're going through a bit of a lockdown, and so I've got my kids on Zoom calls as well. Sometimes this works really well, and Michael, sometimes we run into issues. So what I am going to do is I am going to stop my video, and just so that there's enough bandwidth that we can get the presentation. I hope that's okay with everybody.
That's perfect.
So to get started, we really have four key issues to explore when we examine debt and cash flow management leading up to retirement planning. I hope we can find some common ground today for this discussion. And the first question that I have is, would you agree that cash flow, or the difference between your client's income and liabilities, is the driver of all goal achievement? I have yet to meet somebody who would say no to this question. Put another way, if a client came up to you and said, I really need a financial plan. You know, I really need to work on my insurance needs and my investment needs. We gotta get something built here. And you said, fantastic. What kind of cash flow are you working with? And the client says, oh, I've got nothing. I've got no cash flow to give you. Are you able to help them? No, you really aren't. And when we kind of take that a step further, would you agree that despite your advice and efforts in helping your clients save for retirement, you have concerns for some of your clients outliving their retirement savings? I mean, we know clients are living longer, more active lives, yet our own debt survey found that 52% were not confident they are saving enough. As well, it's estimated that nearly half of retirees will have no employer pension plan. And so what we find is concerns by you and your clients about being able to enjoy a comfortable retirement lifestyle free from financial stress, it's becoming more challenging. And then really by the end of this session, I hope we can all agree that we can extend the life of your clients' investment assets as well as reduce financial stress throughout their retirement. Our third point is when we add to that fact about our concerns for clients and their retirement savings, would you also agree it's becoming harder for clients to retire without a mortgage or some debt? Take it one step further. Will it be it'll be harder for them to stay out of debt in retirement as they have these large expenses such as, you know, automobiles, home repairs, and all of those things are on the rise. I mean, we don't even need to chat right now about our new currency being lumber. It's crazy how much some of these things have changed. And really for some time, Equifax Canada has been pointing out that debt among seniors is increasing. A few years ago, so this is from 2017, it rose 4.3%, which outpaced every other segment of the population over 18. And there's been numerous surveys completed on the percentage of Canadians retiring with debt. But I will say the official count from Statistics Canada 5 years ago had 4 in 10 Canadians retiring without debt, which really means 60% are retiring with debt. And again, there are many options when it comes to managing debt in our working years. In retirement, these debt management options need to be even more of a consideration as clients take every measure to make the most of their after-tax income. You know, put another way, when we think about clients' concerns in retirements, tax planning becomes critical. And then finally, the last of our common ground for today's discussion involves real estate as an investment and how it's going to be used in retirement. So, my question to you is, would you agree that even by discounting some of the wild increases in home prices over the last few years, certainly in the last 12 to 18 months, that owning a home has been a good long-term investment? But most clients don't want to sell their home to fund their retirement. Not only is this true, this has increased because of COVID. We are in this phenomenally crazy housing market right now, which has kind of been the result of multiple pieces. One of those pieces being typically our seniors, when they reach a specific age or timeline in their life, they normally look at next steps in selling that family home and moving into a retirement community. Because of the fear of COVID and the outbreaks that we had seen in some of those communities, more and more of our seniors are staying in their homes. This continues to reduce the supply available on the market, which continues to increase the demand and the upward pressure on pricing. The Canadian Real Estate Association cited that the average price for all types of homes in Canada went from just below 151,000. That was in 1996. 2019, it was 468,000. As of right now, we're well above 500,000. It's absolutely crazy how much it's increased. And as financial advice providers, do we want to be the people responsible to tell our clients who don't want to move that they have to sell their home to replenish their investments? Are there alternatives that are more appealing? Because let's face it, when we think about financial planning, the other piece that we really talk about is how interconnected we are in our clients' lives. The decisions we help them make, the advice that we give from a planning perspective impacts their health, their stress, among many other things. In fact, when you talk to folks in the medical community, they will tell you that somebody who has a terminal illness, if you remove them from what is familiar, if you remove them from what is known, their health will decline rapidly. How do we continue to provide great advice to meet their retirement planning needs in a way that does not impact their health and the other areas of their lives? And when we think about this from a cash flow and debt management perspective, who currently manages it? The client. The client owns it, the client manages it. I think the most important question is who's qualified to manage it? And I would say it's advisors. And when we look at it from our perspective right now, 64% of Canadians self-manage cash flow and debt management. Why is this important in financial planning? The big piece of this comes down to your relationship with your clients. And I remember a story an advisor told me a couple years ago. He had acquired these clients. They were one of the first clients that agreed to work with him when he was starting up his practice. They stayed with him for about 35, 40 years. And unfortunately, the husband passed away. Now, he had known this couple for such a long time that he did everything possible to try and support them during this difficult time. He helped with the funeral arrangements. He helped the clients do everything they could for that widowed spouse. And she was extremely grateful In fact, a few weeks after the funeral and things were starting to wind down just a little bit, she showed up at the advisor's office and she said, I have immense gratitude for everything that you've done for me. I have one more request. I just don't know how to do this. And the advisor said, sure, what do you need? He said, I just have these forms that my bank gave me, and I just need your help. I don't know exactly what we're filling out or where to sign. And they were transfer forms to transfer out all of the investments from her advisor to her bank. And the big question that I look at in that situation and I ask is, well, hold on. Between all of the planning, between risk assessment, risk tolerance, making sure short, medium, long-term goal planning, everything that you do for your clients is done. We can chat about portfolio optimization. We can chat about reallocation. There's so many different pieces that we do in planning. Why, after all that hard work from that advisor over such a long time, would the client then go, I need to transfer my money out? And really simply, her number one relationship was with her bank. She was used to her bank. She was used to the tellers in her bank. She was used to the smiling faces every time she went in, which was multiple times a week. And the unconscious, the subconscious piece of all this was she had no problem going to that bank and renewing a mortgage every 5 years until her debt was paid off. She had no problem in the back of her mind thinking, wow, this bank really helped me. They helped me get my home and get out of debt. I think I'm going to stick with them. It is so important that home equity be part of our conversation, that cash flow and debt management be part of our conversation with our clients as we work through financial and retirement planning. And I would say keep in mind your bank, because of that value that they've perceived, that perceived value that they've given to your client by helping them pay off the mortgage, and by helping me, I've got my air quotations up right now, helping them. 77% of Canadians are going to own a home by retirement. And this is where we chatted about this a minute ago. Almost 9 out of 10 Canadians want to remain in their home for as long as possible, even if there are challenges in their health. So that's kind of the base. That's where I want to start our conversation today, is thinking through those key focus pieces as we look at where does home equity fit into this overall conversation with cash flow, debt management, and retirement planning. Now, I really want to focus on the sequence of returns when we speak about this in regards to financial planning. And I mean, put really simply, in a static portfolio, the sequence of returns in the market are irrelevant in the growth of the portfolio. What does that mean? If your portfolio grows by 6% average, say 25 years, it really doesn't matter if it's an actual 6% return, if it's early low, late high, early high, late low. A 6% average return is a 6% average is a 6% average. And that assumes a static portfolio, no withdrawals, no deposits. When we talk about the sequence of returns in retirement, it is the most impactful and meaningful aspect of the ability for a client to have sustainable retirement income. What this graphic is showing is 3 separate portfolios. They're all averaging 6%. It's basically saying I've got a 6% average return in a worst case scenario where we are taking, again, that worst case being a 4-year cycle, the first year being minus 15%, second year being +7, third year being +9, and the fourth year being +27. And it's just going to continue in that 4-year cycle. You can see that on the green line where the graphic goes down 15, up 7, up 9, and then up 27. The purple line is the exact same 4 years of returns, just in the opposite order. We're just starting with the best year and cycling through to the worst. +27, +9, +7, and then -15. And that nice blue line is an average return delivering actual 6% per year. In each scenario, clients are withdrawing $80,000 per year from $1 million portfolio. What this tells us, all else being equal, is the simple sequence of returns from the worst case to the best case is going to be from 24 years of income at $80,000 per year to 37 years of income at $80,000 per year. That's 13 years at $80,000 per year that either is there or is not there to fund your client's retirement lifestyle. 13 years, $80,000 a year. That's $1,040,000 that is left to the sequence of returns. Now, in the past, if your client is on that worst case scenario path, what could you do as an advisor? What kind of advice could you give? And there's a few. I'm sure you've seen these. These are common conversations. Cut back expenses. Clients don't hear cut back expenses, though. Clients hear, hold on, I've worked really hard for my money, and you're now telling me I have to reduce the quality of living. Downsize. And again, now we walk into that situation of downsizing and potentially impacting other areas of the client's life by removing them from familiarity. Same with selling the family home. Again, based on that earlier side, you can see that taking on debt is on the rise for seniors. And then return to work if you're able to. And this is where I get really passionate about this conversation. One of my best friends, his mom was in financial services, and she went to retire right at the height, right in 2008. And her advisor suggested, hold on, rather than retiring, delay that retirement just a little bit. So she did. She delayed it a few years. When she did retire, unfortunately, right after she retired, she found out she had cancer and she passed away 6 months later. The advice that was given to her is standard advice within our industry. That sometimes, depending on the client's retirement plan and their current situation, return to work might be the option. And yet, home equity has not been prolific in retirement and financial planning. I mentioned that 2007 to 2009 timeframe on purpose. I'm sure most of you can remember where you were in March of 2009 when markets hit their bottoms. We didn't know it was the bottom, but it was really scary having markets down 40%. Now, if we take a look at what markets did during that time, if you had put a great plan that targeted a 6% average return, going into the beginning of 2007, you might have been delivering great returns, great perceived value. Your clients might have thought you were a genius. 2 years later, clients are calling saying, what happened? We were doing so well, and now we're down here. And you might be able to say, we planned for 6%. We were at 9%. Now we're at 4%, but this is all part of the plan. It's all part of the potential scenarios that we've talked about. The challenge is clients don't agree, though. Clients don't think, I'm still on track. I've been doing well with 4% average gains over the long 20-year long-term trajectory. This is going to be okay. It's going to rebound. Clients don't think that way. Clients tend to say, I've lost this much money. And keep in mind, it's always the amount that they've lost from the high point to the low point. They look at the gains from a percentage perspective. They look at loss in a dollar perspective. And that's really why clients have advisors. If we allowed them to make their decisions on a daily basis, they would make emotional, irrational decisions. And this is really proven by the average client return versus the average market return over the last 30 years. Average client returns are typically half of the average market return. And why? It's emotional. They buy high and then they sell low. This year has been such a prime example of this with AMC, with some of these meme stocks like GameStop. And this is really why we highly recommend that clients come to you and let you show them the ideas and strategies to help your clients understand that, yes, there's going to be great market returns and there's also going to be lows. But I want to take a look at one of the opportunities. From the high point before 2007 to 2009, when markets recovered from that correction and came back to that same 2007 level, it was about 5 years. What if you could have helped your clients avoid having to draw income and crystallize their losses over 5 years? Now, that's a long time to keep a large pool of money in money markets, or short-term funds. And specifically, when we look at our environment right now and how low those markets are, it's not in most cases the best interest of the client. Here's the other piece, though. If you could have helped your clients wait just 2 years from halfway down to when markets came back up, you would have bypassed 2/3 of that market downturn. And on top of that, when those clients that come to you emotional, potentially irrational, and they see these declines, and then they sell the portfolio against your advice, the last piece that you then need to chat with them about is the tax repercussions. The longer they've been invested with you, they're going to have an ACB. They're going to have an adjusted cost basis, and they're going to have to pay tax on the gains, even though they feel that they've lost money due to them actually crystallizing the loss. It's no longer a paper loss. And so the question that we like to ask is, how do you want clients to measure your performance? By the performance of their portfolio, or by the overall advice that you provide? Going back to our graphic, I would ask, do you agree that of these different scenarios, we really don't know which one is coming? We have no idea. We don't have a crystal ball. I think COVID's been a great impact and a great reminder of that. If you would have told me over a year ago that because of a virus that started in a farmer's market in rural China, it was going to stop the entire global economy and shut everything down and put us into this crazy system that we're in right now as we try and manage through. If you told me that, I wouldn't have believed you. Again, but we don't have a crystal ball. We don't know. So absent a crystal ball, all of your plans and all the portfolios that you build are all still subject to this sequence of returns. We just don't know what it's going to look like. Imagine what the difference would be in these three return scenarios after just year one. In the worst case scenario, after taking your 80,000, you're already down to 800,000. In the best case scenario, you have 1.2 million. So 1 year of these returns being flip-flopped is the difference of $400,000. That's a huge risk. And what we are trying to do is support removing that risk and preparing our clients that we know one of these three scenarios is going to happen. We don't know which one, but we have a solution for you. We're not going to put you at risk of that worst case scenario. We're going to remove that risk from the equation. The way we do that is finding an alternative asset to take the money from in year one. In this worst case scenario, if we do not have to take the money from the portfolio that's down 15% that year, we can basically reset that sequence of returns line. It follows a new path all the way to that expected terminal date. In hopes that we have the same amount of income longer, simply by using an alternative asset class, we can move that income stream from 24 years at 80,000 per year to 31 years at 80,000 per year. Again, that's an additional $560,000 your client would have available simply by avoiding crystallizing those losses in year one in a down market. But let's take that one step further. What if we were able to reset the best line? What if we used home equity to help start our retirement planning when returns on their portfolio were going well, were going fantastic? What if we could reset and push out that best line? I think you'll agree there's an opportunity for us to look at home equity as an option to help us move the retirement planning further out. Now, the challenge is when we add banking in as a factor, banking today is very inefficient. You may have recalled over the last couple of years that some media outlets had exposed banking practices where clients were not fully aware of the products that they had purchased from their bank. It was actually the Financial Consumer Agency of Canada. It was Commissioner Lucy Tedesco who recently completed a report on this. And his comment was banks are in the business of making money. The way they sell financial products and manage employee performance can lead to sales cultures that are not always aligned with consumers' interests. This is really important for all Canadians to know. And it really does position us uniquely within the marketplace because we truly want to put the customer first. This is why we've aligned ourselves with independent financial advisors. And we tell clients if they don't currently have a financial advisor, we've got folks all over the country that we'd be happy to introduce you to from the independent advisor network. And when we think about the inefficiency of banking, take a look at this graphic. Most of us have checking accounts and savings accounts and mortgages and lines of credit and credit cards and car loans. Sometimes we have these things at 2, 3, 4 different banks. It doesn't really make sense. But the biggest question we like to ask your clients is, why do you have a bank account to begin with? Again, when I ask that question, most people look at me like I've got two heads or I've gone crazy. But really, what is a bank account? It's a parking lot for your money. Your money drives in, you hope it parks, and then that money drives right back out again. I mentioned at the beginning of this presentation that my kids are home right now. My kids are 8 and 9. And I will tell you that there's a lot of people smarter than me, wiser than me that have warned me. Beau, listen, I understand your bank account's a parking lot right now, but as your kids get older, it's going to turn into a roundabout or a freeway. It's not going to be that parking lot. And again, if it is that parking lot, fantastic. But the reality for most of us is not only is it a parking lot, but it's paid parking. And when we think about that and we ask clients from a planning perspective what they consider their greatest financial asset, most of them consider their greatest asset to be their home. And this is where we get really excited to share and educate with clients. Because we ask them, how do you afford your home? How did you afford the down payment? How do you afford your mortgage payments, your property taxes, your utilities, your upkeep, your maintenance? How do you afford all that? It's your
Beau,
income. Yes.
don't want to interrupt, but I'm going to interrupt anyway. We're running out of time. We have another presenter that starts at 11:45.
Okay.
Just so you know. So if you can wrap up in the next couple of minutes, that'd be great.
Absolutely.
Sorry to interrupt.
Thank you so much, Michael. It's really your income. Your income is your greatest financial asset. And what are you doing with it right now? It goes in that bank account and it earns nothing. And that's what we want to do. We want to change that. We want to move it so that your income is always working for you. We want your income to go into an account like Manulife One, where every single dollar immediately offsets the principal on your debt. And again, I know we have lots of concerns. I'm going to go past these slides for a second because the last thing that I really want to point out is this right here. At the end of the day, everything that you do in financial planning is extremely important. And that's why when you look at this slide, we have that graph at the top and then we've got Manulife One underneath. We want to help you finance that financial plan to make sure that as clients are in the acquisition phase of their financial planning all the way through retirement, that we've got access to all assets unencumbered to help make the best decisions possible for those plans. Thank you so much for your time. I hope this has provided a little bit of insight into the sequence of returns and how we can work with supporting that retirement planning.